What's up, guys? I want to go over a weekly review with you and how the week went and how we were able to profit off of this move to the downside. So let's get started. On April 4th, we had the biggest downside reversal of the year. This specific candle, if you go back, it engulfed a whole, let's see, a whole month's worth of data going back to March 1st, essentially. And the high and the low was pretty much all the closes of the last month, almost two, were inside of this one candle. So that's called a mother bar. So what we were doing at this candle, at this day, our trend journal, we decided to turn that to a zero. So that made no trend. Now, notice we are in between the 30-day and the 20-day moving average. We're just kind of chopping up and down around them, so you can't really decide whether you are in an uptrend or not. Notice when we are in an uptrend, we are above a 21 and 30-day moving average. So then we were chopping around. We had a decent day on Thursday, expecting to kind of break out of this range maybe. And then on Friday last Friday, we had a downside reversal, horrible day, and then a continuation on Monday. So because of the downside reversal on Friday, we put our trend into a -1. So this is a start of the downtrend because of an expectation breaker. So that was on the 11th. Actually, that's on the 12th. And so the 12th was the beginning of our downtrend. And so then we saw a continuation, 1, 2, 3, 4, 5. So now we are on the fifth downtrend day. So now we are below the 21, below the 30, and below the 50-day moving average. So this gives us more of a cautionary bearish environment for the short term. Notice we are displacing to the downside, failing to move up almost every single day and then closing at the lows. Also keep in note, ever since this day, essentially on January 30th, we have had more sell spikes than buy spikes throughout the whole NASDAQ 100. More distribution days, more clusters of sell spikes, then we have clusters of buy spikes. And then as we're getting to the end of this consolidation, now it's just we see giant skyscraper volume of these sell clusters. So that shows institutional distribution in the market. So even before, as it was going sideways, we were mentioning, hey, this is looking distributive. We see these little small sneaky signs that say institutions might be distributing the indices and stocks. And stocks weren't holding up as well, and the indices were just kind of going sideways. So that was kind of our tell to say, hey, we are going to get out of our longs. I got out of almost all the longs I was in. I was just in one Halliburton long, and then the rest we're just day trading after that. And so throughout the week, we've just been day trading with the opening range break strategy, or the orb, as we all call it as well. What that is when you're taking the first 15-minute candle of the day and you're trading with direction of the first 15-minute candle. So as it breaks that first 15-minute candle, there's your entry, and we are going to go in that direction. So today our first 15-minute candle was here. So 9:30, we had a small overcut that failed to break out. So once we get our first 15-minute candle, we wait and we watch. So here, right after the candle was formed, the beginning of that next 15-minute candle, it wicked up and failed to break below. So that's kind of another tell that says, okay, maybe we are going to continue lower. We also got above the overnight highs, just barely. So here is our 3 o'clock or 6 o'clock highs. We just barely wicked above that and started to continue lower and get rejected there. So we're expecting kind of a downside move. We are in a downtrend. We are, by our trend template, we are in a downtrend. And so we're looking for the orb to break to the downside. So once it does break, you get into this candle here. Stop loss right above that candle, or as you see at the beginning of this next 5 minute candle, you did wick up to the orb to right to the top of that range. If you look here, we went right to the top of that range and then continued lower. And so then when you get this, we put our Fibonacci's at the orb. So start at the top and then go to the bottom if you're to the downside. Start at the bottom, go to the top if you're going to the upside. Right here, we are going immediately, our first target is 1 standard deviation, bare minimum. You're not going to cut before a 1 standard deviation. And for this specific trade, that was a 2.5 R, 2.4 R. In a bearish environment and in specific trends, you kind of can let them hold a little longer. Generally, you see a bounce around the 3 standard deviation move. And notice we came down and we came right to that 3 standard deviation, and then we've seen a pretty healthy bounce to the upside and then continued lower. So if you were trading this, you can use a time-based liquidity. You can use our Fibonacci's where you just 1, 2, 3, very simple, as your targets, or you can use a trailing drawdown. That's your choice. That's where it kind of becomes discretionary. And so you enter right here as it breaks down, and then you continue to the downside lower. If you were to hit this until the lows here, that ended up being roughly 200 points to the downside for a very nice move to the 3 standard deviation. So next we'll go back and we'll look at Thursday. We're just going to go a day to day on how you could have traded this. Thursday was really nice because we had a pretty large opening range. And when you have a large opening range, you tend to have a lower probability of a heavy move outside the orb. Today's range was a 70-point move. Right here, top to bottom, it was 71 points, roughly 70 points. This range here for yesterday was 123 points, I think. 128 points. So a much larger opening range. Therefore, you're not expecting as big of a move outside of that opening range. So the strategy may not work as well. And this is kind of what you see. You don't see a 1 standard deviation move. You don't see big displacement to the outside, and you don't really see very many 15-minute candles. You see very many 15-minute candles close outside of this orb throughout the day. And so that's where you can tell, okay, it's just going to be a no trade day. When I see a larger orb, I'm expecting not to trade or expecting a failure of this orb. So notice we came up here, we failed this orb, we came down and had displacement back in, retested the high of the range, and then continued lower. So if you were to trade this, you could have traded from the top of the range or the bottom to the bottom of the range. More advanced technique right there, which I'm not going to go into the depth of. Next Wednesday, we have our orb here. Start at this candle and then stop here. 640 to 930. We immediately broke below. There's your trigger. You can enter right at the end of that candle. No problem. You can wait till the 5-minute candle closes. Generally, what I'm looking for is that 5-minute candle to really start breaking down towards the mid to end of the 5-minute candle, not necessarily right in the beginning of the candle. And then again, you just notice the range on this as well. This is just about a 50-point range for your orb, not very large. That's what we really want to see. Right there, 3 standard deviation move. That's where your good targets are. So target 1 standard deviation for a very bare minimum. And then this bounced fairly heavy. Once you got to the 3 standard deviation move, it had about a 70-point bounce. So that's not something that personally I like to hold through. So I like to just get out. Plus it was the pre-market lows right here. So you got a time-based liquidity, plus you have a 3 standard deviation move. So that would have gotten you a 4.8. Great risk to reward there. And then Tuesday, again, you have this wasn't a very great day at all, but the orb was just kind of sideways throughout the day. Notice that with the orb, it doesn't really break a lot of this pre-market highs or at all, and it's actually at even a tighter range. And this just kind of went sideways throughout the whole day. As it as it tried to break out, it could never really break these pre-market highs, the 440, the 745 highs, and it never really broke the lows. So again, once you get this choppiness, this is for me personally a no trade day. I don't even like to bother with any of this. And then on Monday was a very nice day, a nice trade. Boom here. You have your orb right at the 730 or 930. This one was really nice because the first 5 minute candle created a fair value gap, the first couple 5 minute candles. And so you could use that fair value gap to look into and notice it's respecting that fair value gap. So you're expecting, again, the orb to break to the downside. One, you know your higher time frames are in a downtrend. We went to a downtrend on Friday, the Friday before this Monday, on the 12th, I think it was. Yeah, on the 12th. So we went at a downtrend on the 12th. So one, we're expecting a down move because of that. Plus two, we have this fair value gap here confirming the current price action is looking to go to the downside. And what we do, we broke immediately to the downside there, and there's your trigger. And then once again, we tagged right into on the third candle after we broke below. We're gonna sweep below. We created a fair value gap again as we broke below the orb. That's another confirmation that this is going to work. And then we went into that fair value gap on this next candle and tested the orb and immediately rejected. That's an alternate entry. That's a great entry right there. You can enter on the close of that candle with a stop loss at the top of that candle. And then once more, you're looking for either standard deviations or time-based liquidity. 3 standard deviations worked out very well, just like we tend to look for. 1, 2, 3 standard deviations. See, the 1 standard deviation kind of gets choppy, and then once it gets below there, it tends to go to that 3. And again, that's right below Friday's low, which worked out very well. Came below Friday's low, bounced up, retested it, confirmed that we are continuing to the downside, and then continued even lower. These 4 and 5 standard deviation moves are a lot more rare, but in the beginning of trends, like right now, we are in day 5 of a new short-term downtrend. And so the beginning of trends, you see larger moves, which allows you to kind of hold these the trades a little longer, expecting to close either in an uptrend, you would be expecting it to close at the highs in the beginning of an uptrend. At the downtrend, you're expecting to close at the low of the day or near the low of the day, so you can hold your trades a little longer. And so that's how you were able to get around the day, the whole week. That's how you could have traded it with the orb every single day, and how we were able to use our higher time frame trend system that we have to confirm our downside higher time frame moves. So if you have any questions, let me know. Thank you guys for watching. Enjoy the rest of your day.